Hello, my name is John Mulcahy. I'm a vice president with BMO Harris Bank's Commercial Real Estate Group. I split time between the Chicago and Milwaukee offices. I'm also a proud graduate of the Marquette Real Estate Program and happy to help out today with a lecture on commercial mortgages. So we're going to cover three main topics today. Types and objectives of commercial property lenders, important lending concepts, and then walk through a couple of examples, one of a permanent loan and one of a construction loan. So first things, types of lenders. I've listed the primary types of lenders on this slide. Starts with commercial banks such as BMO Harris Bank, life insurance companies like Northwestern Mutual Life, large pension funds like CalPERS or California Public Employees Retirement System, the CMBS market, collateral mortgage-backed securities, originated by firms like Goldman Sachs or Morgan Stanley, other Wall Street firms. And then there's also alternative lenders, government-sponsored financing, mezz debt, second mortgage financing, or joint ventures where they have a piece of equity and the debt. Off to the right, I comment on two important questions to consider for these lenders. What are their source of funds, and what is their risk profile? Take a commercial bank, for example. Their source of funds are short-term depositors' funds. So they're looking to place shorter-term loans to match those shorter-term deposits. Conversely, life companies and pension funds, their source of funds are life insurance premiums or retirement contributions with long-term payment obligations. They're looking to make longer-term loans, generally higher dollar amounts. And then the CMBS market, collateral mortgage-backed securities, not going to spend a lot of time on that today, but the basic concept is the pooling of 50, 100 loans together, tranching them up, and then selling them in a bond-like or an equity-like fashion to Wall Street investors. Moving on to the objective of a lender. I try to make this pretty simple. The first, second, and third objective is to get the principal paid back. Keep in mind the risk-return dynamic. Your lender today makes a return of maybe 3% compared to an owner that's looking to make 10% plus. Bear in mind the owner can lose it all, but the lender's margin is just too thin to take a chance of losing principal. They're not in the business of owning real estate. They don't want to own real estate. They're looking to make a loan, make it a return on that loan over a period of time, but then get paid back. Moving on to important lending concepts. I'm not going to hit on all these, but first and foremost are the loan documents, the mortgage and promissory note. The promissory note's pretty simple. It's a promise from the borrower to the lender saying we are going to pay you back with these specified terms. The mortgage is the actual document that gives the lender the right to foreclose or take over ownership should the borrower default or not be able to pay back that loan. Amortization versus interest only. Interest only is simple. The borrower pays interest only over the period of the loan, and when the loan is due, the full principal balance is due. Amortization is paying back a portion of that principal over time. In the text talks about two different types of amortization, a fully amortized versus a partially amortized. The difference here relates with the term of the loan. So a partially amortized loan would have, for example, a 5-year term and call it a 30-year amortization. So over 5 years, the loan will be paid down incrementally with a portion of the principal, but then there will be a balloon payment at the end of year 5 whereby the full balance of principal is due. Recourse versus non-recourse. This is an important concept for commercial banks especially. They're looking to get recourse. They want a guarantee, a personal guarantee, typically a principal of some sort that's putting their personal financial strength behind the deal to ensure success and repayment. Prepayment penalties. This is basically a lender charging the borrower a penalty to repay the loan early. This might seem a little strange to some of you after I just ranted about how getting your principal paid back is most important, but really think of it in this light. A life insurance company makes a loan for 10 years and expects that principal for 10 years, or expects that return for a 10-year period. If the borrower repays that early, they have to find another source or another place to put those funds and earn an equal or better return. So they basically insert a prepayment penalty to avoid any problems and to ensure that return. Finally, our lending ratios. I understand these will be covered in more detail in a future lecture, but just to keep an overview, you have loan to cost and loan to value, LTC and LTV respectively. It's basically percentages of the loan to either cost or value. A debt service coverage ratio, whereby it's the property net operating income, NOI, divided by your annual debt service. You're really looking at the cushion that the property's cash flow can handle volatility before they start to maybe jeopardize debt repayment. And then finally is the debt yield. This is a newer ratio since this last economic crisis, with a lot of lenders foreclosing on real estate and owning real estate. It's simply your property NOI over the loan amount. Finally, we're going to walk through a couple of examples. These are purely hypothetical, Milwaukee-based examples, something I think you guys can relate to, and to paint a picture on a couple of key differences. First is the permanent loan example. We're going to look at Bayshore Town Center in Glendale, Wisconsin. 1.2 million square feet, 89 tenants anchored by Boston store Kohl's and Sears. The risk profile is relatively low. You have a stabilized asset with a track record. You have strong occupancy. A potential lender for something like this is a life company or a CMBS loan. Your terms are generally going to be a minimum of probably 10 years, 25-year amortization, if not greater, a fixed rate, certainly with a prepayment penalty to lock in that return for the lender. Generally, it'd be non-recourse with an asset as strong as this, with likely no covenants or a very light covenant package. Finally, a construction loan example. We're going to look at the Ivy on 14th. This is the new 80-unit, 165-bed project on Marquette's campus. The risk profile here is a little higher. You have new dynamics not in a permanent loan, such as construction risk. Who is the general contractor? Who are the developer? Are they going to be able to build the project on time and on budget? You also have market risk. What's the supply demand in the market? Can they sustain the additional units? What kind of rental rate are they looking at? How does that stack up to the existing supply? Clearly, there's a level of risk here that's not in a permanent loan. A potential lender for this would be a commercial bank. They're going to be making advances or draw requests through the construction period. Likely a shorter term loan, 2-year term, to get construction completed. Likely interest only through that construction period, a floating rate with no prepayment penalty. And generally speaking, looking to get some level of recourse from a principal that's going to support the project. So these were just some highlights for commercial mortgages. We went through it pretty fast, but I hope it was helpful, and good luck with the rest of the semester. Thank you.